If your income is above these levels in 2024, you may already know that you can't contribute directly to a Roth IRA, but there's still a way for high income earners to get money into everyone's favorite investment account, and this way is known as the Backdoor Roth IRA. However, it can be complex when doing a Backdoor Roth contribution, so in this video we're going to cover two major mistakes you need to avoid that could ruin the entire strategy. Hey everyone, my name is Jake Skellhorn. I'm a certified financial planner and the co-founder of Spark Wealth Advisors. My channel and my firm are both dedicated to giving you more confidence and clarity with your money. So first and foremost, if you're not familiar with the Backdoor Roth IRA, just a quick background on it. Basically, it's a way to get money into a Roth IRA if you make over those income limits that we mentioned a moment ago. And the way you do that is simply one extra step, which is making a non-deductible contribution to a traditional IRA, which has no income limits to do so, and then simply converting that money to a Roth IRA, which also has no income restrictions to do so. The first mistake that you need to watch out for and avoid if you're planning on doing a backdoor Roth is called the PROU Rule. The PROU Rule says that all of your traditional IRA balances are considered one in the eyes of the IRS when you go to do a Roth conversion. So for example, if you have an IRA with pre-tax money, but you want to open a separate one to do your non-deductible contribution for your backdoor Roth, when you do that conversion to the Roth IRA, it's going to lump both of those IRAs together and consider some of that conversion taxable since you have pre-tax money in one account. So just as a quick example, let's say that you have one IRA with a $95,000 balance, all of which is pre-tax money, but you open a second IRA to do your backdoor Roth contribution and make a non-deductible contribution of $5,000. Even if you only convert that $5,000 of non-deductible money in that second IRA, IRS is going to consider that $5,000 as 95% taxable and only 5% non-taxable. So this is the pro rata rule in a nutshell. So if you have any pre-tax IRAs, just know that you could be taxed when you do your conversion, and it may not make sense to do the backdoor Roth at all. There is a common workaround for this as well, where you would essentially take that pre-tax money in an IRA and roll it into a 401k or a 403b, any other employer-sponsored plan that will allow you to roll money into it. And that way you no longer have pre-tax money in an IRA, so the pro rata rule does not apply to that money anymore. You would definitely want to check with your employer's plan first to see if they allow incoming rollovers from IRAs. Not all of them do, and you typically do have to be an active employee, so you can't just roll it into an old employer's 401k plan. But that's essentially mistake number one to look out for, the pro rata rule. If anything needs clarification here, make sure to leave a comment below and I'd be happy to answer any questions. The second mistake to avoid is not filing the appropriate tax forms to ensure that you're not taxed twice on the money that you're contributing for your backdoor Roth. So once again, step one for a backdoor Roth is making that non-deductible contribution to a traditional IRA. Step two is converting it to your Roth IRA. When you make a non-deductible contribution to the traditional IRA, that means that money has already been taxed. So that money is typically coming from your checking or savings account where it's already been taxed by your employer or whatever other source. Typically, when you're converting money from a traditional IRA, which is commonly a pre-tax account, to a Roth IRA, which is an after-tax account, the IRS will recognize that as a taxable event. However, when you're doing a backdoor Roth, you want to make sure you file Form 8606, which essentially keeps track of all of those non-deductible contributions that you're making to the traditional IRAs and essentially lets the IRS know, hey, I've already paid taxes on this money, don't tax me on it again. You will have to file this form each and every year that you plan to do a backdoor Roth IRA, but it's a pretty simple form. I believe it's only one page, so pretty straightforward, but do not forget it. If you don't file it, you could leave yourself open to paying taxes on that money twice. Another bonus mistake that I just thought of as I was filming this that I see all the time is don't forget to invest that money once it gets to the Roth IRA. Don't forget that these first two steps are all cash. In other words, you're contributing money from your checking account to the traditional IRA as cash, converting it from the traditional IRA to the Roth IRA as cash. Unless you have an advisor or work with some sort of platform that will automatically invest your money, it's typically on you to go in and buy those securities or investments so that money grows over time, which is the whole purpose of a Roth IRA. So that's a bonus mistake to avoid. Make sure you invest it. But just to recap, number one, avoid the pro rata rule by rolling any pre-tax money into a 401k or 403b plan if you can. Number two is file Form 8606 to make sure you're not taxed on that money twice. And once again, don't forget to invest it. So that's a brief overview of the common mistakes to avoid with the backdoor Roth IRA strategy. If you've heard of the backdoor Roth IRA, you may have heard of the mega backdoor Roth, which is using your employer plan to get even more money into a Roth account. I did a separate video on that where I do a deep dive into that strategy. If you want to check that one out now, here it is. Besides that, I hope you enjoyed the video. Consider subscribing to the channel and sharing this with a friend if you found it useful. Other than that, thanks for joining, and we'll see you in the next video.